Hi there everyone, today, we're exploring a key tool in international tax law, double taxation agreements, or DTAs. For anyone who lives or works internationally, understanding DTAs is important, so let's dive in. DTAs are agreements made between two countries to prevent income from being taxed twice, both in the country where it's earned and in the country where the person lives. So, how do DTAs interact with the country's own tax laws? Here's a common scenario. Let's say there's a law in country A that taxes a specific type of income heavily, but country B's DTA says this income should be taxed only in the country where it was earned. In this case, the DTA generally takes precedence over country A's national tax law, meaning country A must respect the agreement. This rule, called treaty override, is a big reason DTAs are reliable and respected worldwide. Before a DTA comes into effect, though, it goes through an extensive process. First, there's a negotiation between both countries' tax experts. Then, each country's government has to approve it, usually through parliament, and finally, it's published in an official gazette. For anyone navigating international taxation and double taxation agreements DTAs, the tax authorities in each country offer valuable resources. Here's a quick overview of the DTA resources from the US, UK, and Spain. United States Internal Revenue Service (IRS). The IRS handles US tax matters and provides detailed information on tax treaties that the US has with various countries. Their tax treaty tables page breaks down agreements country by country. The IRS also includes forms, such as Form 8833, for reporting treaty-based return positions. United Kingdom, HM Revenue and Customs (HMRC). The HMRC handles UK taxation and offers a detailed tax treaties page, with information on existing DTAs, organized by country. HMRC's site also has a double taxation relief manual for detailed technical guidance. Spain, Agencia Estatal de Administración Tributaria (AEAT). EAT manages Spain's tax affairs and hosts a section on DTAs to eliminate double taxation. On the AEAT site, users can access a searchable list of Spain's DTAs by country. These pages provide information and DTA forms like Modelo 247 and Modelo 206 for reporting tax treaty benefits. For many countries, these DTAs are based on models like the OECD or UN models, which set out specific rules on how and where to tax income. These models reflect different priorities. The OECD model, often used by wealthier countries, favors taxing income where the person lives, or residence. So, if you live in country A but work in country B, the OECD model generally allows your residence country A to tax most of your income. The UN model, on the other hand, is often preferred by developing countries and emphasizes taxing income where it's generated, or source. This way, country B, where the income originates, also has tax rights. In the OECD model, determining where someone lives, or their residence, is very important. This is usually the country where they have a permanent home, family, or economic ties. If someone has homes in two countries, the DTA specifies ways to determine where they truly reside, using factors like where they spend most time, their strongest financial ties, and, ultimately, even their nationality if needed. DTAs help prevent double taxation by deciding who gets the tax rights between two countries. Sometimes, only one country gets the right to tax certain income, even if the owner lives in country A. Other times, both countries can tax the income, but there are limits on how much each can charge. Usually, the country of residence provides a tax relief or credit to offset any double tax. So, let's talk about these methods for preventing double taxation. First, there's the exemption method. With this, one country simply doesn't tax certain income at all. There's also a version called exemption with progression, where the income isn't taxed directly but affects other taxes. Next is the credit method, where your country of residence lets you subtract the tax paid abroad from what you owe at home. Finally, there's the deduction method, where the foreign tax you paid is treated as an expense, lowering your taxable income at home. This one isn't as common and is generally less favorable. Let's look at some examples of how income is handled under DTAs. Take rental income, for instance. Let's say James lives in country A but owns a rental property in country B. Country B, where the property is located, can tax that rental income fully. Meanwhile, country A, where James lives, might also tax that income, but then allow a credit or exemption so he doesn't pay twice. Then there's limited taxation. Let's say James holds stock in a company in country B and receives dividends. Country B can tax these dividends, but DTAs often cap this at 5 to 15% to make it fair. Country A, his residence country, can still tax these dividends, but would allow a credit for the tax already paid in country B. Finally, in this approach, the residence country allows the taxpayer to deduct foreign taxes paid as an expense from their taxable income, reducing their tax base rather than providing a direct credit. You can find more detailed information in our website. DTAs are essential for international businesses, travelers, and investors, as they create clarity and fairness in tax responsibilities. So next time you or your business crosses borders, check if there's a DTA in place. It can make a huge difference. Thanks for watching. We are looking forward to your comments and experiences in double taxation. Be sure to like, subscribe, and hit that bell for more content on international finance.